right now we're well over $1 trillion in committed capital looking for companies to buy right this second. That capital is just sitting there waiting for something to buy. And so we want to create the something that they want to turn around and buy. This is how you can create 100 million net worth in 5 years.
Welcome to episode 5 of Can You Make 9 Figures Doing This? And on the last episode, we literally talked about the accounting world and bookkeeping being so hot in the roll-up. The idea of a roll-up is this: you take your companies and you put it under a bunch of other companies, or you go seek out and put together a bunch of companies, get it to $4 million at EBITDA, sell it for over 30 million, get it to 10 million, sell it over 105. Adam and I do deals all over the world. He is the best-selling author of The Empire Builder. I'm Millionaire Underdog. Adam has had 2.46 billion in exits, 58 company acquisitions. I'm a nine-figure entrepreneur with over 70 companies and brands in 55 countries. We do deals all around the world, and we're here for 2 reasons. We're either going to give you the knowledge here on this show so you can do it yourself or be informed, or we're going to do it together or show you how to do it. Either way, go to adamcoffey.com or in the link in the chat so that we can find ways to do business. And I strongly recommend you go back to the episode number 1, talking about landscaping. Every show you will learn. Adam, good to see you again.
Good to see you, JT. Hello to everybody listening out there. It's I'm sorry that these episodes have been, there's been some gaps in between them. It's like JT's running all over the damn world. It's like between his schedule and my schedule, it's like the only time we can do this is like dark 30 in the morning. So it's Saturday morning, at 7:30, Central when we're recording.
By the way, we should just do a show by us texting each other, because that's the that's like the only way we get in there. I want to start off by something, and I don't know if you read this. This was in the Wall Street Journal, because I think this is a play where involving risk. So Tony Robbins bet $200 million on a green energy breakthrough, which was the idea of basically taking clean energy and turning it into hydrogen. And the idea was literally going to be like motivational with I'm talking about, look, if you take a look at it, he bought an old power plant with some dude and some equipment, put $200 million into it. Apparently may have gotten $75 million back, but now they're pretty much safe. So basically it's
sounds like Kevin Costner's new movie Horizon.
Well, basically they're saying this article that the guy's pretty much admitted that it may never work. And if it did, it would have changed the world. So, on one hand, I'm a little suspicious of this, because why would Tony Robbins put 200 million of his net worth, which is, I imagine, a large chunk, right? And that's to be cash available, to put it into something like this. Maybe you put like a $2 million bet or 20 million, but 200. So is it his money? Did he put a group of money in? So there's a lot of things I don't know.
I'm guessing it's a group. Right. They used him as a headline marquee name. Yeah.
Okay. But let's talk about the difference between the PE world of investing in roll-ups, right? And we're talking to those, and then we'll talk about, for those of you, how the private equity works versus the investing in companies. And I think there's people like, I'm investing in this company, and it's sort of what's called venture financing, pre-seed funding, Series A.
Yeah. So boy,
what's the difference between the both risk-wise, and what are your thoughts on those?
Yeah, so it's unfortunate. So we've got venture capital, and then you've got private equity. Venture capital is a subset of private equity. Where I work and where you work is in a subset that's called buyout funds. And so let me just explain the difference. So venture capital is an investor in ideas, and they're hoping for the next best big thing. It's like, I'm going to put a bunch of money into a fund. They're going to invest in a lot of little startups, and maybe, just maybe, one of them will turn into the next giant thing, and we'll make so much money on that one, it'll overcome all the losses that we make in all the others that wind up being just kind of dead ends. And that's the theory behind venture capital. But here's the thing, venture capital, unfortunately, is the most accessible type of, I'll call it, alternative investment when we're talking about private equity and private capital. It's it's like the easiest to access for small investors. But, and I can't tell you how many times, JT, people reach out to me, people in my network, or just people that family, people I know, friends, aren't wealthy. They don't have a lot of money to invest, but they reach out to me and they're like, hey, Adam, I got this opportunity and I got 50 grand. That's all I got in the world. And I can be an investor in this venture capital fund. What do you think? And they'll send me the prospectus or the investment circular. And I got to be honest with you, if you look at venture capital investment circulars, almost none of them, matter of fact, I have yet to see one that actually beats the S&P 500. It's not good returns. It's not a good place. There is a place for venture capital. Don't get me wrong. Sophisticated investors with large portfolios, we should always be swinging for the fences with some little part of our capital and our investments. So we need a diversified portfolio. Venture capital can be a piece of that, but it should not be an entrepreneur or a small person, small investors, kind of big shot. That's like a lotto ticket, and they normally don't pay off. And so buyout funds is the category where we work. And the difference is, where venture capital is an investor in ideas, buyout funds, which is the largest segment of private equity capital, that is an investor in mature companies that have a track record and a history of revenue and earnings. They've already beat the odds that the venture capital or startup, can suffer from. And, so many companies fail. 34 million small companies in the US, and yet only 7% of them ever get to $1 million in revenue. Only 4% of those get to 10 million in revenue. The odds are stacked against startups and venture capital world. Private equity buyout funds invest in mature companies. Each company that I built for the 9 private equity firms that I built them for, they had been in business for 40 years before I got there. So they had decades worth of customers being served, revenue, not always the best stellar growth, but they survived. They beat the odds. They learned, how to service a niche, or a part of a market in an industry that they were servicing. And so that's the difference, and the way private equity works just in general, so people know, I'm sure most people listening to this episode know what a mutual fund is. And so a mutual fund aggregates a bunch of money. I can go on my Schwab account right now, and I can invest in a mutual fund, and Schwab will aggregate all the money of a bunch of individual investors, put it together, and a fund manager decides what stocks to buy in that mutual fund basket. We have instant liquidity. I can buy the stock today. I can sell it tonight. I can sell it tomorrow. I can hold it for 10 years. They're publicly traded. I can read Morningstar to see how they're rated, see how past performance was, and try to guess what's the best one to invest in today. That's a world everybody understands. Private equity, a little bit different. We aggregate money from a bunch of investors, but they have to be accredited investors. And the typical minimum investment size is $5 million. That's the typical minimum investment in a private equity fund. And when I make that investment, it's not liquid. I don't get my money, instant liquidity. I can't sell it tomorrow. The private equity fund lasts for 10 years. And during the first 5 years, they're calling capital from me. So I don't even send them my 5 million. I pledge the 5 million. I fill out a bunch of paperwork. I prove that I'm an accredited investor. They accept me into the fund. I'm earmarked for 5 million. As they buy companies, they have 5 years to 6 years to deploy the capital in the 10-year fund life. They'll call me. I'll send them, wire them money, as they're buying stuff. And then my money is to work. That's the tide rolling out. It can roll out of my hands. Money can roll out for 5 to 6 years. When they buy a company, they then generally have about an average 5-year hold period with which they're growing it. They're doing a buy and build. They're doing this roll-up strategy. They're also growing it organically. They're improving margins. They're doing all the things that we need to do to build a balanced growth-based business. And then they have to sell the business, because they have to return that capital to those shareholders, those investors, those limited partners who've committed this $5 million minimum capital. As a result of that, You know, I have no liquidity. I'm sending them money for 5 years, and then the tide rolls back in. And for the next 5 years, I'm getting my money back with the returns. The private equity firm keeps a 2% management fee that they charge every year on invested capital. Usually it's the companies they buy. They take that money out of the cash flow of the companies. So usually I'm not writing a check for that. And I'm an investor in many private equity funds. And so they take that. And then what they keep for themselves to generate their wealth is for every dollar of profit that they make, they keep 20 cents on the dollar and they give 80 cents to their investors. And in spite of the keeping 20%, on average, historically, private equity funds have returned at least 2 to 1 what the S&P 500. So the typical S&P 500, if I invested in an index fund over a 30-year period, I could expect to make about 8% a year. And that's even in all volatility market, different times in history, that's the numbers. And so with private equity, I'm looking for 16 to 20% on average annualized return. And what I get, is this higher return. What I give up is I give up the liquidity and I have to make a large investment. So that's kind of the difference between venture capital, private equity, a mutual fund, and a private equity fund.
So I wanted to talk about this idea of when the private equity, and on another show, we'll talk about how to get to the private equities, but what do they take a look at? So I have a private equity. You've dealt well with the private equity. So people come in and they sit together. What happens, right? So they look at a company and what do? What's the strategy? Because obviously we talked the other show about us. We're putting companies together and put it to a private equity. What are they thinking? What's their strategy? What kind of people? Because we are dealing with the problems, the issues, the staff, right? And in essence, what we're doing. And that's why private equities are willing to pay a premium. And they're willing to pay a premium because they just want a nice little box with a bow on it so that it just could be like perfectly done. And so that is why they're willing to pay a premium for a company that's put together, well-oiled, well-machined, as opposed to us fighting and clawing and dealing with all the problems that they may have had or the consolidation. What are they thinking? What are they doing? What type of people work there? Because they're not entrepreneurs, they're private equity. So they're good at raising money. Operators, like, tell us about how that world works.
Yeah. So, these are all good nuanced points, right? So I'm an operator, I'm a guy who's CEO. I run companies, I've held every job a guy can hold on an organizational chart over my career, and
Including
so
General Electric and some of these big companies with Jack Welch and
yeah, so I mean, I earned my right and earned my way up to CEO of large company by working my way up the ladder and starting at the bottom. And so I'm what's called an operator. I'm a guy who knows how to run a company, how to get it to grow, how to bend the growth curve, get it to grow organically, because we can't just do a roll up. These have to be balanced growth companies that we're building. They got to be growing organically. They have to be improving their margins. And then we do the roll up strategy on top of those. But I got to have all three levers working, and if I've got three levers working, which, I know how to do, I'm a guy who runs a company. I need capital. If I'm an entrepreneur and I want to build $1 billion business, of which there's only 3,000 on the planet, if I want to be one of those, I'm going to need a lot of money to do that. And I'm not going to do it purely organically. I'm going to be doing I'm old. I don't have time to go from 0 to $1 billion. And so it's like, I need to move fast. I've got 5 years typically if I'm doing this for a private equity firm. And so I'm going to do all of this stuff simultaneously and very fast. So I'm going to need a ton of capital. So my expertise is building and running the company. Private equity's expertise is giving me the capital that I need, feeding me the capital I need, helping me solve for I call it the capital stack. There's going to be equity, there's going to be debt, and I'm going to need lots of it if I'm going to build a big company really fast. And so the people that work in the private equity world typically are the smartest, people on the planet. They're spreadsheet jockeys. These are financial people. They're not operators. And so there's a marriage that we need. I need the financial sponsorship, and I need, I'll call it the operator. The two of us, it takes both in order to build this company. The financial people just do not have the wherewithal to operate the business. And so they can't do it without me. I need the capital stack solved for. And although I can try to solve it for myself, they're much more efficient at doing that. So we need the two of us working together. We're each other's tools. They're taking money from their limited partner investors. They've built their fund. They're going to invest in their companies, and they're going to need somebody to run it, build it, and do the work. I'm the guy who does the work. They're the guys that supply the capital. It's a marriage made in heaven. And so the interesting thing about private equity is that they come in different sizes and shapes. They're not all created equal. You and I and everybody listening out there have heard of firms like Blackstone and KKR, these really big ones. Their fund sizes on average are 10 billion to 30 billion. And they only have 10 years to deploy their capital, buy companies, build them, return the capital. Then you got small funds. There may be funds out there with less than $100 million in size. They also have 10 years to deploy capital, build something, and sell it. And so, because PE firms come in different sizes, they also invest in different size businesses. And so, big funds buy big companies, little funds buy little companies. And nary do the two mix. Little guy doesn't have enough money to buy a big company. Big guy doesn't have enough time to buy 1,000 little companies to put a $10 billion fund to work. And so very disciplined capital, smartest people on the planet, people who go into the private equity world, typically top of their class in finance, accounting, and very smart people, but they couldn't manage their way out of a paper bag if they had to. And that's okay, because they got me. I'm the tool that they need to build the company. They're the tool that we need as entrepreneurs to solve for the capital stack. Because if that capital stack is solved for, then it's just a function of how fast can I buy companies? How fast can I put them together? Can I harness the synergies? Can I invest in technology and ERP systems and making that company more efficient as it's getting bigger? And when it works and it works well, I'll also just tell your listeners out there that private equity are the most generous investors on the planet. They give away 10% of their profits and proceeds, in the company to the employees who are making it happen. When it works and it works well, there's plenty of money made, and it's spread around for all to participate.
The world right now, let's talk about the capital. And so I've done over 1,000 real estate deals. I have a lot of different companies, and I found that real estate deals have just stopped. I'm seeing a lot of capital. You're seeing a lot of capital. We're all seeing a lot of capital. We're just not seeing the deals, and partly in the real estate space because, I did a video. I have a 2.2 mortgage for 30 years, right? I wasn't going to get it, but in 2020, that's like, they're like, if you put X amount to an account, then we'll just give you a 2.2 mortgage to try to get my business in the high net worth department, right? So like 2.2 is free money, like pretty much.
I'm at 1.89. It's like,
yeah, but mine's 30 years. How long is yours?
Oh, mine's 10. I'm at 10. 30-year
still,
mortgage, but 10-1 lock at 1.89.
No, after like 10 years, it's going to go to like the 7.5.
I won't be around here in 10 years in this house. I never am. Yeah.
Where are you going to go?
Just pay it off.
Where are you going to go?
No, meaning that, so my average time in a house is about 7 years, and so I get bored, so it's kind of like with cars, I get bored.
I know, but you live in a nice area in Texas, a private country club.
So I'll find another nice house, maybe in this club, maybe in a different club, but I move around.
Are you happy with that decision? Because you are one of the nicest clubs in there. Looking back, I was thinking this morning because I was like walking around. I was like, man, I made a great decision, which was by accident. Are you happy with the decision?
And mine kind of was too. I just kind of dumbed it.
Both the exact same thing.
Yeah.
It was both like the same thing. It was like you were in California, I was in Chicago, and I'm like, screw it, we're moving. And then next thing you know, you ended up in the best country club in Texas, Dallas, and I ended up in the best one in Nashville.
Boy,
So
we're
it's
off
kind
on a tangent, but I'll tell you how I found this place. I went on Zillow and I said, "Show me houses over 5 million." And in the Dallas Fort Worth Metroplex, there's three areas that light up where there's real estate. Somebody told me who lives here, they said, "Adam, don't go there. That's old money. That's oil money. That's multi-generational money. You don't fit in over there." These two areas, that's new money. And then I showed mama the two areas, and then she started looking at schools, and then it was like, okay, now I'm here. And then once I was there, it was like, okay, I'm coming from outstate. It's 2020. There's riots in the street. I don't know how far the society's going to decay at that time, and it's like gated, guarded. The kind of celebrities that live in this neighborhood here, it's like it's a no-brainer. It's like, okay, done. Only one place for me to be, and I'm in it. So that's kind of how I found it. But we're off on a tangent. That's
no, but
another one.
I mean,
Yeah,
listen,
but let me tell
by
you.
the way, when it works, you
Yeah,
can afford to make these decisions
yeah.
to pick the 10.
But let me tell you what you were talking about, because you've had me on a lot of stages recently. I'd say, with rooms filled with real estate investors who are just not happy with the kind of returns and just the state of the real estate investment. So these are successful people who've generated, a decent amount of capital and returns, and now they're looking for, hey, this isn't doing what it used to do. It's kind of a weird market out there. What's my alternative? And I think that's how you and I originally came together. It was about, well, if there's 2,668 billionaires in the world today, 93% of them made their wealth in business. Only 7% made it in real estate. And so, what is this real estate versus business kind of thing? And so, that kind of is where our marriage, started, was you and I collaborating on taking the wealth and the people who were successful in business that started investing in real estate, and now showing them how to invest in business where a lot less capital is required. And when I talk to any real estate, and I don't care how rich they are, it's like their number one problem is always capital, capital, capital. I need more money, need more money. It's like, this project, I've got 100 million in financing, but I need 8 million in equity. It's like they're always looking for capital. And the amount of capital required to do what I do in business and these roll-ups is just infinitesimally smaller than what's required to do it in a real estate environment. And so it's much more efficient with capital. And likewise, I think it's efficient with time. Different kind of world, and we have to learn how to do that. And so there's a lot of people out there who are successful in business who became real estate investors with the cash that they were generating in their companies. Now what we're doing is we're teaching them how to go back to their companies and say, let's do something special with the company that started generating your wealth to begin with. And if you don't have a company and you don't have wealth, then let's acquire a business and start building it. And in my world, it's always better to acquire an existing business. Some of these bookkeeping companies we were just talking about in that last episode, it's like, good Lord, these numbers are so fantastic that why the hell would I take any risk of starting anything when I can use the money in a business to buy the business and generate cash flow, and I can start with something that's already been proven to be successful. And so I think that's what we're doing now, is
Is
teaching
there
those.
a chance that maybe these Ps will slow down acquiring companies, or because they have a lot of capital, it's either they give it back to the investor or they got to buy something?
None. JT, that's a great question, because the one cardinal sin of private equity is not to deploy their capital. So if I've raised a fund, let's say I've got 500 million in a fund, a guy like me has taken $5 million and has set it aside. I can invest it in stocks. I might be able to put it in a money market. Now I'm getting 5% in my money market fund, so that's not too bad. Was zero about 18 months ago, but now it's
Right, but we're
5%.
also paying taxes on that too. So unfortunately,
Yeah, but I have to reserve that capital and wait for them to call it. Now, if they don't call it, not only did I not get my 16 to 20% return from them, but I also missed an opportunity to get at least 8%, call it, in an S&P 500 fund. Now I'm pissed. I reserved capital. You didn't use it. I didn't get the return I'm looking for. They come to me and say, Adam, I'm raising my next fund. Would you like to be a spot? Would you like to invest in my next fund? I'm like, screw you. You didn't put my money to work. So the one thing private equity can't do is not make investments. They can be good investments, bad investments, but by God, they damn well better make investments or they're out of business. They won't be able to raise their next fund. And so that dynamic and the fact that because PE returns have been higher than the S&P 500, money keeps pouring into that asset class. More and more firms are being created. More and more funds are being raised. The fund sizes are getting bigger, and so as a result of that, right now we're well over $1 trillion in committed capital looking for companies to buy right this second. And I read reports of somewhere between 1.2 and 1.9 trillion in committed capital looking for something to buy. And because of the size funds and the amount of time they have and the fact that they're disciplined, swimming in their swim lane, that capital is just sitting there waiting for something to buy. And then when something comes up from the bottom of the pyramid and gets thrown up as a softball, then the sharks are all circling, trying to hurry up and buy that thing. And that's what drives up the prices. And so returns for private equity may be moderated, in this generation of funds because interest rates are high and they can't use as much debt as they used to. There has to be more equity. But nobody cares because all private equity funds that are of this vintage time period are going to be rated against other funds of this vintage time period. So the whole system is built to our advantage. That money has to be invested. They have to buy something. And so we want to create the something that they want to turn around and buy.
That's a good point. And listen, it takes a little bit of work. And I think the issue is this. If you have an expertise in real estate, and that's what you've done, and now you got to learn something new, and you have money and you're worth millions of dollars, right? When you have no money, you're hungry, right? And I've seen something happen with investors, Adam, is that people get too comfortable. And now they don't want to go back down the ladder to learn a new skill and to work as hard as they did. But unfortunately, the enemy of success is comfort. And I've seen that time and time after again, many, many people. But they go in, they make a couple $1 million, maybe they make a couple $1 million a year, right? And they're happy, they're satisfied, maybe 3, maybe they had a record year at 5 during COVID. So now they think they're on top of the world, 30-day vacations in Europe, this and that. They lose that hunger. And now, real estate's down, right? Their business is down. And they don't have the will. It's kind of like the McGregor factor I talk about, right? Like they're not as hungry anymore. And so you keep talking about how successful you are, but the results are not there anymore. And so you have to refine that hunger, which a lot of people don't as well.
Yeah. Well, so you and I have talked about this before. It's like the difference between a millionaire and a billionaire. At some point, a billionaire went all in. A millionaire knows how to make money. Billionaire went all in. And
or even to the 9-figure, I'd say I never took my foot off the accelerator. I mean, this is a Saturday morning, really early. You are not. It's the only time we're available. You just turned 60. Look pretty good for a 60. I have to be. I was a little shocked.
Well, thank you, man. It's like I rode a hurricane in Cancun for my 60th birthday. I want to tell you a quick story about because it's about commitment. And I want to talk to you about one of my clients. One of my clients is a family office, and he was living in Singapore, and he reached out to me, says to me, I want to be worth $100 million. I want to make $100 million, and I want to do it in 5 years. And I told him, can't be done. Cannot be done in Singapore. There's only 5.7 million people or whatever it is, the GDP, the economy. It's just too damn small. You're not going to do it there. Well, I grew up in Australia. Ain't going to do it there either. Your stated goal, you want to do it 100 million in 5 years, starting with 0. Now he had money, but he's like, that's my goal. I want to do a roll up. I want to create $100 million in 5 years. Like, you aren't doing it there either. 26, 27 million people, not a big enough GDP. There's only one place in the world where you can do what your stated goal is. So if that's truly your stated goal, You have to do a roll up in the United States. I also told him he could do Europe because the combined EU is got arbitrage like the United States does. This guy literally moved his entire family to 4 miles away from me, and his kids now go to school with my kids. When I meet with him weekly, he is in my office. Talk about commitment. He picked up his family. He moved from Singapore to Dallas to come be near me in the one market in the world where there's enough arbitrage to where I could show him the formula. And it wasn't even a secret formula. You and I have been talking about it on all these episodes. We don't have to do a giant roll up. Let's do 4. Let's do 4 of these. Get one going, a year in, start the second, year in, start the third, year in, start the fourth, and then exit, 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 exit. And I showed him the path. This is how you can create 100 million net worth in 5 years. So he teamed up with a couple of his investor buddies in Australia, and literally, they put the capital in, and now we're doing the roll-ups.
On the next show, we're going to talk about the $100 million formula. That will be episode number 6. But in the meantime, if you want to learn how we do what we do, or you want to do it together, adamcoffey.com, link below. Let's make things happen. And please do me a favor, like, subscribe, share. It doesn't cost you anything. If you want more of this.
See my ducks walking by the window?
No, but I don't know why you have
Tony Soprano, right out the window. It's like, I don't know if you can see it. There's a duck up there.
And you're watching Seinfeld. And
yeah,
so it's like a whole episode there as well. So thank you, everyone, for being on. Thanks for listening. Thanks for your support on the show as well. It means the world. We do real deals in the real world. And on the next show, we're going to talk about what was this formula that he told him to as well. And we're going to talk about this thing about boring businesses that you're seeing a lot online, and whether it's legit or not. And we'll also talk about laundry facilities. We'll talk about a lot of things in the future show. So make sure you like, subscribe, and you put the alert so you can be notified. We'll see you next time, everybody. Thank you, Adam. See you later, everybody. Episode 6 coming soon.